Yes, now let's get more on Chinese markets. And today we are joined by an outperformer. Michael Liang, Chief Investment Officer at Foundation Asset Management, joins us, and his company oversees about $80 million. And its opportunity fund has beaten the Bloomberg long, short, and also multi-style benchmarks by more than 50 percentage points since its inception, and also has beaten both by about 10 percentage points so far year to date. Michael, welcome to the program. Hope you're doing well on this Thursday.
Thanks for having me.
All right, Michael. So let's talk about all this talk right now about, people expecting the Shanghai Composite to fall even further. Andy Xie, Morgan Stanley's former Asian chief economist, says maybe another 25% decline is in the works. Also, another technical analyst today saying 10%. How do you see the markets playing out?
Well, I think to talk about the day-to-day movements of the market is probably not our expertise. But if you look at the worry getting people edgy every day, mainly talking about the loan growth, the money supply. I think if you look at, we remain 5 months of the year, we'll have $1.8 trillion to be lent out. That's still a doubling from the same period last year. So liquidity is not tight, but fine-tuning is a function of growth. So in our point of view, I think the market need to go through this adjustment, which is probably going to be, in terms of the loan growth, not going to be repeatable what happened in the first half of the year. But I think by and large still is very loose.
So if there is adjustment, then that must translate into adjustment on the stock markets, does it not? So are we in for some declines in the near future?
Well, I think if you talk about the Chinese Asia markets, I mean, that's always tend to be moved by the policies and retail sentiments. I think it's a little hard to judge. I mean, but if you look at the offshore Chinese market, which we focus most of our attention on nowadays, I think it's by and large driven by fundamentals. I think in a sense what I'm saying is the Chinese economy has stabilized. It's gone through the period of recovery now, but how strong the recovery is going to be is depend on the external economy. So I guess the picture is kind of more positive than negative. So I'm not too worried. Okay,
more positive than negative. But do you have a contingency plan in place if, let's say, there is a sell-off in the next month or so?
Yes, we'll have to buy more, I guess.
You buy more at that point? You go in and buy on the dips?
Yes. I mean, if you look at the valuations people worry about, if you look at the historical price to book, I think it's probably a more reliable indicator for now, given we have a very early stage of recovery. So a lot of earnings has not come through yet. So pure look at the 2009 earnings, I think is kind of misleading. If you look at 2010 earnings, I think we're pretty much at the historical average, and the price to book as well. But of course, if you look at 2009 earnings, on PE terms, market is probably one standard deviation above the mean. Kind of expensive in a sense, but earning will catch up, in our opinion, and also consensus. Market looking for 20% earnings growth for offshore Chinese market for next year, and 80% growth for Taiwan next year. So if you look at those scenarios, on PE terms, they might be expensive now, but they are not in 12 months' time.
Okay, we will talk about Taiwan. That sounds like some huge potential for those stocks. But let me just get back to Chinese stocks. Okay, I'm just giving you scenarios of what the investors are thinking these days. They're thinking, should I go in and short this market if it's run up so much? And it seems to be driven by sentiment that declines are on its way. So what do you need to see before you will start shorting the market?
We find ourselves spend most of the time looking for quality names to buy. So to short, I think you need more of a different skill sets. I think you're not looking for the fundamental turnaround for a business. Also, you need to know a lot of macro scenarios. I think in that sense, there are some areas I think have gone too far. I think expectations are too high. I mean, namely...
what sectors have gone too far, too
maybe
fast,
not
too
so
high?
Popular opinion, but I would think in the universe of base metals.
Base metals?
And base materials. And also, the problem for us, looking at the Chinese financials, mainly talking about banks, because the majority of them are government-owned. If you look across the world, most of the banks owned by government tend to trade at discount, because it's not a free market-driven kind of operations. So they probably deserve a discount. But China is unique. So we find ourselves very challenging to give a proper valuation for Chinese financial companies.
So you would actually go in to short these banks, is that what I'm hearing?
No, I wouldn't go that far,
right.
But for us, we probably say, well, avoid
banks at this point and avoid the base metals. That's pretty interesting because, we just had the story about Alcoa on this morning. Stephen Engel from Beijing was talking about Alcoa, saying that China's going to buy more aluminum. Also, copper prices are expected to rise from here because of Chinese demand. So why do you think base metals should be avoided? Because they've run up too much, too fast, not much more gains in these stocks?
I'll take a look at the Alcoa's comments today, but I thought he was talking about China is back. So he's probably betting his money on China. I think it's the right thing to do over the medium term. But if you really talk about the next 3 months, I think there's has been a huge run-up in aluminum prices, for example, and China is self-sufficient in aluminum. So there's a discrepancy between the Chinese aluminum futures trading at a premium to the LME. I mean, does that make sense? I mean, it makes sense to a certain extent for a short-term period, but I think the discrepancies will normalize.
Okay.
So in that sense, I'm saying is maybe the running up have caught a lot of people wrong-footed. But how high it's going to go and how much, this stock building and re-inventory, restocking scenario are going to play out, I think we're pretty much by and large already at the end of it. Okay.
Well, Michael, we have to get a commercial break right now, but I do want to talk about Taiwan because, you talk about these growth potentials of 70% or so. That really, of course, piques investors' interest. So we'll talk about Taiwan afterwards. Also talk about some of your Chinese stock picks as well. We're talking to Michael Liang of Foundation Asset, which has beaten the benchmarks by 50 percentage points since its inception and 10% so far year to date. So we'll have more with Michael Liang. Also, we'll visit the U.S. investor sentiment as well. So stay with us here on the Bloomberg Edge. Okay, welcome back to the Bloomberg Edge. Today on the program, we're talking to an outperformer. Foundation Assets Chief Investment Officer Michael Liang joins us. And Foundation Assets Opportunities Fund has beaten the Bloomberg benchmarks by 50 percentage points. Its inception about 3 years ago. So let me just get to some rumors that are coming across the wire, some news actually, Michael, because right now we're looking at the A shares in Shanghai rallying about 1.7%. But there's a lot of discussion that the A share IPO market will be suspended from mid-September. Do you think there's a possibility of that happening?
I think there is a possibility. I mean, if you read through the PBOC and CBRC's comments regarding fine-tuning, I mean, I think the pro-growth stand has not changed. Market sentiments is a little edgy. I mean, it's understandable, those anxieties still looming large, given we still just come out of a reverse recession in a decade. So people look at China as well. I think in that sense, I understand it's all about fine-tuning not only the banking lending principles, also fine-tuning the market sentiment, given Chinese markets still underdeveloped at this stage.
Right, but with the 60th anniversary of the founding of the Communist People's Party, you don't see any non-pro-growth policies coming out of China, right?
Well, I think it's a big milestone, but having said that, I mean, how important financially for medium and long-term investors, I don't think really, in my opinion, is non-event. But if market do have a huge volatility up and down, I don't think it's anybody's favor. So I guess, I mean, the fine-tuning, exactly the fine-tuning interpretation to me is there's no preset policy settings. It's all depend on what's going on a daily basis. So in that sense, I think it's very smart.
Okay, well, you said that there's pro-growth policies on the mainland. Your allocation, let's just go through some of your allocation right now. You're fully invested at this point.
Yep.
70% of that would be in Hong Kong stocks, 40% China-listed ones? Or China-based ones?
Yeah, 70% Hong Kong, but I split half and half, Hong Kong and Hong Kong, China.
And Hong Kong, China. Now, 25% is actually in Taiwan shares. And you're talking about 70, 80% profit growth for next year. But, when people look at Taiwan, they look at the PE ratios, and it just looks incredibly expensive, even from a bottom-up perspective for these stocks. So where is the value in Taiwan?
Again, if you look at the PE multiples for 2009, it'll definitely look expensive because it will be one standard deviation above the mean. But having said that, if you factor in 70% earnings growth for next year, it does not look expensive at all. So at this cycle, it's like usually you buy base metals when its PE is high. I mean, for typical cyclical stocks, I mean, tech names are cyclical.
Right.
Even with factoring 70% EPS growth, earning growth for Taiwan for next year, still about 10-15% below the 07 levels.
So
on nominal
discount.
dollar terms,
right.
yes. So it's a very shallow, it's a very sharp recovery in a sense.
Okay, so what are you going in to buy in Taiwan? What are you holding these days?
I think there's two areas of sectors you can look into. Tech names, I mean, that's 60% of market cap. I think that's
a big industry there, yeah.
Yes, I mean, you got Windows 7 coming through second half. You got the PC replacement cycle over the next 18 months. Mm-hmm. So that's all boding very well for tech names. I mean, if you look at the names like MediaTek, like Winstron, all those names going to do very well. Mm-hmm. Not only play on China, also play on these, PC cycles and domestic names.
Yeah, you seem to like these tech names because that's the same story in your Chinese stock picks as well. You like the likes of Baidu, which operates the biggest search engine in China, Tencent, really this unspoken unspoken hero in China because it's done so well, but you don't really hear about this company. But let me just start off with Baidu because, of course, this is one of China's, I guess, dolls of the market, shall we say. But a lot of people say this is very expensive. I mean, sure, its second quarter profit did rise about 45%, but its operating margins are actually lower than its competitors, such as Alibaba, NetEase, Sohu. Is it still worth buying into since it's run up so much?
Well, Baidu has a very different business model. They are in the search engine business. Number one, have 63% market share in China. Mm-hmm. Their business model, is, for our opinion, that's why we focus on those free market economies. Those market shares are earned by battling the ground in the field for years and years. And those market shares earned for good. I mean, as long as they keep the business model going, as long as they keep trying, I think they can weather the storm a lot better than typical companies in cyclical business. What about that kind of business? Yeah.
Sorry. What about valuations? I'm just looking at the graphic that we have up here. I mean, it's up 148%, and it's if we're looking at next year multiples, right? Price to book is double that of its peers. So if you're an investor, if I buy in now, do I make any money, say, in the next 12 months or 6 months?
Yeah, I mean, it's difficult. I mean, for a quality name like that, you don't really come across a lot of them in our space. Mm-hmm. So when you come across like that, you probably, for this kind of names, because the return on capital is very high, and then you probably need to look at the PE to growth, the PEG ratios, rather than just purely look at the PEs, because PE does not take into account the potential growth potential there. Okay,
well, let's talk about Tencent quickly, because again, unsung hero, because you don't hear about this company very much, but it's been doing hugely well on the mainland. It owns the largest, I guess, IB, instant messaging service, the QQ. It also does online games as well. But Tencent, the stock has more than doubled so far this year, second best performer on the Hang Seng. How much more upside do you see for Tencent?
Well, upside is going to be gradual from now on. I mean, there was a valuation normalization period, but that's, in my opinion, by and large behind us. Mm-hmm. Going forwards, we need to see earnings. Probably going to be prime driver for share prices. In that respect, I think Tencent is very secure.
Very secure in that sense. Can I keep repeating, though? You keep hearing about 85% quarterly profit growth. Can they continue on that pace?
Well, there's many ways they can monetize their business. I mean, they have, so many subscribers. I think there's a chance for them to come out with a new product and monetize this business. It's a very good potential there.
All right, Michael, thank you so much for joining us today. Really nice to see you. Thank you for dropping by. Michael Liang of Foundation Asset.